name is Rob Berger. This is our Monday night live Q&A. For those already joining, please give me a thumbs up if you can see and hear me. I think I got the microphone thing worked out. Obviously, I'm using the one that you can see at the moment. I realized in my tests that I ran last week, and you guys helped me with, that it wasn't really a fair test because I have it's called Cloud Lifter, but it basically adds gain, adds volume to a microphone. And I have one of them, and it's currently hooked up to the microphone that's in front of me. It's not hooked up to the one that I'm not using at the moment that's above me. So when I was comparing the two mics in terms of sound, of course, you can turn your own volume up. But it wasn't really a fair comparison. So I need to figure all that out. But I thought I don't know, I kind of like this one for the live show. Thanks, Milton, for the thumbs up. Because I don't know, it's got that radio kind of vibe to it. Anyway. So how's everyone doing? You enjoying the stock market and the bond market? Well, we already got a question. Matt says, to survive this market, any thoughts on covered calls to generate income? Well, I've given you my thoughts on covered calls. We can talk about it. But I thought I would... Hasten says, I knew the test was rigged. Yeah, tests are always rigged, aren't they? So I wanted to give you my thoughts on the market. It was down a lot last week. Inflation is still, inflation. The UK is having all kinds of issues. So I was looking at the S&P 500. So let me show you. This is the S&P 500 year to date. I'm actually looking at VOO, VOO, which is Vanguard's S&P 500 ETF. And we're looking year to date. And it's off, we'll call it 22%. It's at we'll call it 340 right now. But it started the year at much higher, almost 440? What was that? 438, I guess. So, that's not a lot of fun. And we could go to like a BND, which is a total bond market fund. And we're looking at losses. I looked it up earlier today. I think it's around 13%. I can double check. And so how do you deal with this? Well, if you're accumulating, meaning you're years from retirement, and you're adding money, but you look at your balance, it's down, obviously. The thing to me, having lived through that part of my life, it's easy. You like that, how easy it is? But it really, you had a couple of things going for you that folks my age and in or near retirement don't have. One is, you're not relying on that money to live, right? You have your job, you're still, contributing, you have, you're paying your bills, not from your investments typically. And so even just from a psychological perspective, it's a huge advantage. But then, that you're buying, if you should make contributions to a 401k every month or every paycheck, IRAs, whatever, you're buying in at lower and lower prices. So long term, it's a huge advantage. And so really, if you're accumulating, you should hope the market goes down even further and we have an extended bear market. Nothing could be better for you than that. But when you're in retirement or near retirement, then it changes, right? But anyway, there's a point to all of that. Let me go back to BND. I'll show it to you real quick. Here's BND, and we're down, wow, almost 14%. And so particularly for those, well, for everybody, but particularly for those in or near retirement, how do we frame that issue? Someone had emailed me and asked if they should sell and go to cash. It was a serious question. I started doing some YouTube short videos, which are 60 seconds long. That's the longest they can be. And you might say, Rob, I find it hard to imagine you can say anything in under 60 seconds. I get it. It's true. My wife would agree with that sentiment. I manage somehow. But for me, I haven't changed anything. I haven't gone to cash, haven't sold any, same asset allocation, haven't changed a thing. And so there's a few things that I find helpful in times like this. The first is, and this relates specifically to the fact that both stocks and bonds, and by bonds, I kind of just mean a total bond market kind of fund, which is an intermediate term fund, and the S&P 500 or total U.S. stock market, if you prefer. They're both down by double digits. One of the things that I take comfort in, this may be an odd thing, but I do, is that we're really in a probably once in a lifetime kind of year. What we're seeing this year, as far as I know, has never happened, at least since we've been tracking returns over the last 100 plus years. And that is, we're both, investment grade, sort of intermediate term bonds and the stock market are both down double digits. I can show you a chart that is I've shown you this before, but I'll show it to you again. This is just returns going back to 1928. This is from New York University. And you can see this first column here. I know it's probably hard for you to see. I'll make it a little bit bigger. Is the S&P 500, and it includes dividends. And obviously there were bad years. Here's 1931. It was off almost 44%. But if we go all the way over, I know this is probably giving you a headache as I scroll through these, and we look at like 10-year bonds, right? Although they have an exclamation point. I don't know, that means a typo. What is that? Anyway, you can see they weren't down. Now there are going to be years where they were. Let's look for a double-digit year. Here we go. This year, I don't know what year that is. That's minus 11%, but we'll scroll all the way over. And stocks were, there you go, 1940. So it's happened once where they were both down double digits, right? Got to go back. Let's see another double-digit year right here. Scroll over. I know it's probably not the easiest way to do this. So they weren't down double digit, still a bad year, of course, from 1946, but not quite down double digits. And we come back. Where do we get another double digit loss? Here's one, 10%, go back over. Stocks down 8%. So far it's happened once. I don't think it happens again. Here's two bad years, maybe here. No, markets were up big time, 18 and 31. So the point is, what's happening this year is incredibly unique. Maybe not in a good way, but it just doesn't happen or happens rarely. And I think that's important. Here they were up 1.33. So I could keep going, but you get the idea. And so the takeaway is, as bad as things are within both the bond and stock market, it's not normal. It obviously it has happened. We saw once there, just looking at that data. But we shouldn't treat this as a normal year, because it's not a normal year. And we shouldn't make, in my view, investing decisions based on what's happened this year. I had some folks kind of, I guess, rib me a little bit. Is that the right word? Because I had said in a video a while ago for retirees to keep as little in cash as you can tolerate. And so folks left some comments like, oh, how's that working out for you, Rob? Well, that's kind of a silly way to think about things. I mean, in any given year, your approach is not going to be the best, right? I mean, it's just not. I mean, we can look at any asset map, asset class map, return maps. Here we go. Let's look at I was looking at one earlier. Here it is. See if I can make it a little bigger. That's not bad. Here we go. So this just shows you returns. This is from 07 to current year to date. And the colors just show different asset classes. So EM is emerging market, international. What's AA? Oh, just an asset allocation portfolio. I don't know what that is. 60-40 maybe. Oh, here it is. It's down. They define it down here. Anyway, a high grade bonds, large cap, cash, high yield bonds, small cap, and REITs. And if you hover over one, it shows you. So emerging markets, number one, then they were the bottom. Then they were back at the top, then third, then all the way at the bottom, then all the way back up, then all the way to the bottom. I mean, that's what happens. And we can pick anything. Look at REITs. Had some great years there, right? 5 out of 6 years, they were number one, but they've had some really bad years too. And we can go to, let's see here. International stocks have actually, believe it or not, had some pretty good years relative to other asset classes. But they've had some bad years. How about large cap? It's done pretty well, as we know, since 2007, but plenty of years when it was in the middle of the pack. And this year, it's second from the bottom, right above small cap, by the way. If we hover over small cap, well, there you go. So in any given year, whatever approach you take, or components of your portfolio, some of them are going to be really, really bad. It's just the way it goes. If that's all we've just described is a diversified portfolio. That's it. And so, yeah, cash has been great this year because basically everything else has been terrible. I mean, cash is losing money on a real basis, right? Because inflation. But we shouldn't use this once or twice in a century or 3 times in a century kind of year to say, okay, well, now that's what we're going to do. We're going to try to protect our portfolio from years like this. And in the retirement space, I think what a lot of people do is they hold on to more and more and more cash. Let's have 3, 4, 5 years of cash, which this year would have been great compared to having less. We all know that, at least so far. But if we look at history or even a Monte Carlo simulation, that much cash just doesn't hold up over time. You lose too much because 2022 isn't normal. This isn't normally what happens. The other thing I like to look at, and I'm sure questions are coming in, I'll get to them very soon. I like to look at where we were. So like if I go to, we can use Morningstar. So this was the chart I was showing you with the S&P 500. This is the Vanguard ETF. We're just looking at year to date. But what if we go 5 years out? Okay, so when we look at this now, so what we tend to do is compare the current price with what it was at the start of the year right up here. And yeah, it looks bad. What if we go to the depths of the COVID crash in March of 2020 and imagine from here, let's just imagine we had a steady, slow climb and we're here now. We wouldn't even be having this conversation. You guys wouldn't even know what I'm talking about. I mean, it'd be like, what are you talking about, Rob? It's been a nice, steady growth. Or even how about if we even went before the COVID crash? Nice, steady climb, same thing. Now, of course, someone out there is probably thinking, well, Rob, that's good, but what if we crash down even further? Yeah, well, then we just go back further in time. I mean, that's kind of the way it works. I mean, we could have a 2001 and 02. Those were 3 nasty years right in a row, right? But what I've found is that markets do recover. By the way, not because there's some magic in the markets. Remember, all these markets are doing long-term is reflecting the underlying businesses and governments that are represented by the stocks and bonds that we own. That's what it is. Day to day, anything, all kinds of things change the prices. But long-term, all the bond price is, whether there's interest rate risk, credit risk, depending on the bonds, but they're ultimately reflecting the current inflationary environment, the credibility of the borrower. Same thing with stocks, the earnings power of the company. And these things go through cycles and they go up and they go down. And when we're in the middle of something like we are now, all the news, that's what they want to cover, all of the fear, because that's what sells. And maybe because it's certainly a story to be told. But I think if we were to just check the news once a year and check the prices once a year, once every other year, we wouldn't have the angst that we get. So anyway, those are just my thoughts. I'm sure I'll check the chat. You're probably going to have some things to say to me about it. Fire away. I will answer the first question. I don't see it now because I think some of the chat scrolls past me, but covered calls. I don't generally like covered calls as an investment. You can get great income as a yield percentage. Let me just see. I'll pull one up. Covered call ETF. You get 8, 9, 10%. We'll look at XYLD. XYLD. I'll pull this up on my screen. So here it is. And you can see the 12-month yield is 12%. The problem is this. Remember what a covered call is. So you're selling a covered call. I think most of these, I don't know about this specific fund, sell at the money. But what you're doing is what this ETF is doing is selling covered calls. This would be on, I guess, the S&P 500. which gives the buyer of that call the right, but not the obligation, meaning they can, but they don't have to, buy the share from the seller at an agreed upon price. And then that option, it will expire after, it varies depending on the length of the contract. And so you think about it from the seller's perspective, because that's what this fund is doing. It's selling covered calls. You're going to get a premium, right? And you're going to keep that no matter what happens. If stock prices are going up, you're more likely to have those shares called away, right? So if I have a covered call and I can buy a share at $100, and let's say the covered call expires in 30 days, and when we get to day 30, that share is trading at 120. Well, goodness, yeah, I'm going to buy it for $100. You bet. I'm going to thank you very much for that $100 share that's now worth 120, and I only paid $1 or $2 for the option. Thank you. I'll take it. On the other hand, let's say the price has fallen to 80. Why would I buy? Why would I exercise the option, right? Why would I pay $100 when I can just go out to the market and get it for 80? All of which is to say, these funds, covered call ETFs, tend to do pretty well when, pretty well when the stock prices are going down, because who's going to exercise the calls, and they're just going to get the premium. They're still going to lose money, typically, depends on how much the market's going down, but it'll be offset by whatever premiums they're getting. When the market's going up, though, they tend to get shares called away more frequently, and so they end up losing money. And so because the markets go up more than they go down, these sorts of funds, there could be some special purpose where maybe they might make sense. I don't know. But generally, it's like, I wouldn't get too excited about the yield. Remember, what the yield giveth, total return often takes away. And just to give you a sense, so this year, this fund is down 15%. Now that's better than the S&P 500, right? Again, because it's benefiting from the premiums. But in past years, like in 2021, it was up 19.59, as you can see there. I don't know if you can read that very well. Let's go back to VU. So remember, that one was up about 20. VU last year was up 28. So, again, you're happy to own them when the market's going down like it is now, but by and large, I don't find them to be good investments, and the yield you get, doesn't change that. Anyway, that's my view. Again, could there be some cases? Maybe, but I can't think of any. But maybe I'm not creative enough. This is an interesting question. What do you think is the solution for highways that can't handle so much traffic? We can't expand them fast enough. I don't know. I don't think this is that show. Although we do talk about things other than investing, I don't know what the answer is. Maybe someone in the chat can answer that one. Oh, this one, let's see here. This almost seems like one of those questions where, two trains leave stations heading towards each other at the same time. One's going 40. Anyway, question from Janice. A married couple, one works full-time and one does not work at all. Can the non-working spouse contribute to a Roth IRA using, there's a spousal IRA. I've never opened one, but I'll show you. If you just Google spousal IRA, you'll get all of the information you can want. This is from Investopedia. Allows a working spouse to contribute to an IRA in the name of the non-working spouse with no income or very little income. This is an exception to the rule. But, there could be, you'd want to check all the details. But yeah, it's possible. Whoops, sorry, let me take the comment off the screen. So yeah, that's what they're called. And I don't know all the rules to them. Yeah, this is what I was wondering. There's phase outs for married couples filing jointly and for who the spouse making the IRA contribution is covered by a workplace retirement plan. The phase out range is blah, 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 blah. Now, I don't know if that's a phase out range on deductibility or even contributions. but you need to dive into those details. I don't know them off the top of my head. But Janice, it is possible. Doris, thank you for the kind words. James says, survive this market, don't look at it. All right. John likes the mic. All right. Good. Mad Max, first time joining. Well, I'm glad you're here. So this is an interesting question from Banana Maltastic. Thoughts on international REITs? I really don't. I've never owned an international REIT. It's never seemed to me to be something I needed. So I really don't have thoughts on it. I will make a note of the two tickers that you've put in the chat, and I'll check them out. But I just never, I don't know, when I had REITs separate from, if you invest in a total stock market or even the S&P 500, there are REITs in the, in the S&P 500 index or total US market kind of index. Most of my accumulation period when I was saving for retirement, I guess technically I still am, but I'm definitely near the end of that. I own separate a REIT fund, usually about 10% of my overall portfolio. I've done away with that this year, mainly just to simplify. It's not any issue with REITs. I was just trying to simplify the portfolio. That's all. I could go back. I mean, this is all in a retirement account, so there's no tax issues. All right. What do you think about doing Roth conversions in a down market? I've actually done a video on that. Let me pull it up here. Roth conversions in a bear market. Let's see if I come up. I'm third. Look at that. When a Roth conversion in a down market is a smart move and when it's not. The funny thing is I don't really remember what I said. I don't know. Was I making any sense? I have no idea. I mean, in theory, here's what I think I said. And that, man, I'm pretty sure this is what I said. I mean, you can listen to the video. So if what I'm about to tell you contradicts what I said in the video, then I don't know which one you should listen to, me now or me then. I don't know. A Roth conversion from a tax perspective either makes sense or it doesn't. But, if you're going to convert whatever, $20,000, either that makes sense from a tax perspective or it doesn't. The fact that we're in a bear market doesn't make it more sensible from a tax perspective, right? But if it does make sense, you'd rather convert, when the market's down, because the 20,000, you're going to convert more shares, okay? Because their price per share has gone down. It's still going to be 20 grand, but because it'll have more shares when the market recovers, you could see a bigger bounce in your Roth IRA. Pretty sure that's what I said. That's what I believe. I think that makes sense. You guys will tell me if it doesn't. Oh boy, this is like a ticker salad. Which fund combination would be better held in a traditional IRA during retirement? SPTI, SUB, VTEB, or FUAMX, FGSH, VTIP? Thank you. I don't know. I guess I need to figure out what those funds are. I know what VTIP is. SPTI. Intermediate term treasuries. Okay. Well, that would be perfectly fine to hold in a traditional IRA. Number one. SUB. iShares short-term. Well, okay. So SUB is a short-term national municipal bond fund. So I would normally not hold that in a traditional, because as a municipal bond fund, it has some tax advantages. So you're basically getting a lower yield but not paying federal and possibly some state income tax. But if you put it in a traditional IRA, at least if I understand, I'm just, by the way, pulling up the name. I guess I could go into the fund and look at the details, but it's a municipal bond fund. So that would be not one that I would normally see in a traditional retirement account. I know VTEB, but I can't remember what it is. It's a tax exempt bond fund too. So I wouldn't, that's a Vanguard fund. So I wouldn't think that would go in a traditional, that's the kind of fund you would own, by the way, in a taxable account, right? At least that's my view. Hope that makes sense. FUAMX, intermediate treasury. So that'd certainly be fine. I would put that kind of fund if I wanted an intermediate treasury fund in a traditional IRA. VGSH, short term. So again, if that's the kind of fund I wanted, assuming it's, for retirement and whatnot, traditional will be fine. VTIP, I think that would be fine in a traditional account too. I'm trying to think if there's any reason. I don't think there's any reason I can think of not to hold a TIPS fund I think you'd want to hold it in a traditional IRA for the same reason you would a short or intermediate term treasury fund. At least I can't think of any reason not to. So that's my best answers to that question. And if folks have other insights, maybe better insights than I, please let us know in the chat. By the way, the cheating scandal in chess it's continued to develop. Today, Magnus Carlsen released a statement that, as I read it, effectively says this opponent, who Hans Niemann, was cheating, or Magnus believes he was. But he still didn't really offer any proof. It was weird. I don't know what's going on. Okay. So Quincy wants to know, hey, Rob, have you thought about buying treasuries? Well, I have bought some treasury bills. In fact, I purchased some. Well, it hasn't cleared yet because the auction, I think, is Thursday. But I put in an order today. But this is short-term money that we're going to spend next year, and I'm done with that. So what we've put in covers us with what we need for next year. And it was just 6-month treasury bills. And I think I'm going to get somewhere between 3.5% and 4% yield, something like that. I haven't thought about treasuries beyond that. I mean, in my traditional retirement accounts, I have the equivalent of Vanguard's B and D, and I'm perfectly fine with that. I think, by the way, having intermediate term treasuries as your bond allocation is a perfectly reasonable approach. B and D has other types of bonds, right? Has high grade, investment grade corporate bonds, has some asset-backed bonds. So, but I think if you went with sort of an intermediate term treasury kind of thing for long term, I think that'd be perfectly reasonable, in my view. Yeah. All right. This is interesting, Josh. Vanguard sent me a letter saying my funds were below the minimum due to the down market, so I'm forced to buy the dip. The minimum for what? Like, I have this, I have their digital advisor account. Remember, I opened it up with $3,000, which is the minimum, to test it. And I didn't really care for it, but I've left it in there. I'm actually going to pull it out and get some tax losses. But it's like to whatever, I don't know, 24, 2,600, whatever it's gone down to. But they haven't sent me a letter saying you need to top this thing off to $3,000. So I'm curious what minimum they're referring to. So Zong wants to know thoughts on buying an investment real estate property in this market. Well, so I haven't really been focused on real estate. And my sense is certainly the market's gotten soft. Homes are on the market longer as rates have gone up. But I'm not what little attention I pay to it. I do pay some attention to it. I'm not seeing crazy good deals at the moment. I mean, I guess maybe better than 6 months ago, but this is not like a fire sale at the moment. But I also think a lot of it depends on where you're looking and what you're buying. People are investing in real estate all the time, and but I don't see screaming deals, at least certainly not where we live in Northern Virginia. All the real estate I owned, investment real estate I owned in Ohio, and that worked out very well. But we bought it at a very different time, and they were HUD foreclosures, and we got good deals. I don't even know what the HUD foreclosure market looks like right now. All right. Okay, here's an interesting question from Dacian, I guess. Dacian? I don't know. Says, currently I have 9% of my diversified portfolio in VTIAX, which is, I'll pull it up. It's the Vanguard Mutual Fund. It's total international. There it is. I'm going to leave the comment up for a minute. Considering adding VMAX, which is Vanguard's emerging market fund, equal to 5% of current total portfolio. Your thoughts, given that 26% of VTIAX is in emerging markets. So let's talk about that first. So for those of you like, well, wait a minute, how do they know that? Well, we can go to portfolio. 26% strikes me as high, by the way, but I'm sure you're right, but we can look it up. So we're looking at VTIAX. I've gone to the portfolio tab. We're going to scroll down. This gets a little tricky because if you just are looking for it, you're not going to find it. But you gotta realize there's tabs here. So we can go to region. Here's Asia emerging. Yeah, I don't know that 26% strikes me as high. I thought it was high. This is showing about 16% if you add, am I missing one? Asia emerging, there's a little bit of a Europe emerging, and that's about it. Anyway, that's what I see. Maybe there's different numbers reported on Vanguard's website. But the question is, should we add a 5% to emerging markets? So a couple thoughts there. I owned emerging markets separately. I actually put 10% in emerging markets for a long time, and was very happy with that. It's a wild ride. Let me just go back to this map that I showed you. You can see with emerging markets, it's almost like it's either the top or the bottom. There's some that are in the middle, and this only goes to 07. If we were to go back to 03, 04, 05, and 06, those were wild, and even 02, wild years. Let me see if I can find them. How far back? Let's go to Portfolio Visualizer. Let me see if I can pull this up in Portfolio Visualizer, just to show you how crazy this was. I'll show you this as soon as, let me pull it up here. It only goes back to 07. That just must be how much data they have. Oh, they had a different ticker because that's their Admiral shares. They had an investor share that goes back further, I think. What was the ticker of that thing? Which they probably don't have anymore. Let me look it up here. Vanguard Emerging Markets Mutual Fund investor share. See if I can find this thing. VEIEX. Maybe that's it. VEIEX. Let me put it in Portfolio Visualizer. This has got to go back further. Yes. Okay. Whew. All right. So this is Vanguard's emerging market. This is their investor class, which they don't really sell anymore. They kind of merged their investor and Admiral shares a while back. But you can see this goes back to 95. Look at this. So first of all, 99, they were up 61%. And the next year, they're down 27. I actually, sometimes it's better to be lucky than good. I invested at the beginning of 2003, not really understanding what emerging markets were, and I was up 57% that year. And then look at the next few years. But then the bottom fell out. Then it's up, down, up, down, up, down. It's down this year. it's a wild, wild ride. So you just have to be prepared for that. Of course, in a total international fund, that wild ride is occurring just within a more diversified fund. So you're somewhat insulated from the effects of it when you go to look at your account balance, but still 15, 20% or whatever is in an emerging market, it's an emerging market. So if you're prepared for that wild ride, I think it can be a good diversifier. I have read some studies in Morningstar. I don't think I can put my hand on it quickly that actually has said small cap value has proven to be a better diversifier than emerging markets. But that's, of course, looking at history. Whether that will be true going forward, there's no way to know. Having said all of that, I'm not sure I answered your question or not. I think it's certainly a reasonable approach to have some direct allocation to emerging markets. You just got to be, you got to buckle up because it's, you got to buckle up no matter what. I mean, look at this year. You got to buckle up just to own a bond, for goodness sake. Sheesh. John, he wants to know, what is all this talk about the next 10 years of the stock market returns will be flat? Is that what people are saying? Or is that what they did say? The way Jack Bogle looked at it, I've been doing a lot of reading on a lot of fascinating things on the investing world. I've really redoubled my efforts to work on my book about how to invest in and near retirement. So I've been doing a lot of research. And what was his formula? It was, he said that you could look at, let's say over 10 years, you could, the stock market performance would be the dividend yield plus expected earnings growth. Now, there can be a PE adjustment as PEs rise and fall, but that was sort of his rough guesstimate of how, stock markets will perform. So over the next, whatever, we'll call it 10 years. Of course, you got to have an estimate of earnings growth. What is the yield now on the S&P 500? What's the SEC yield? It's not that much, really, still. 1.57%. Kind of surprises me. Anyway. It's interesting, though, John, on your point. I was part of this research I've been doing. I read an article. In fact, I'll show it to you. Yeah, here it is. So this is an app I'm using to do my research. It's called Devon Think. It's just a note-taking app. I've used every note-taking app out there. But this article was written by Wade Pfau, who I do want to have on the show. And it was published, I think, in 2010. Is there a date on this thing? Anyway, I'm pretty sure 2011. And it was a fascinating topic. What he was doing was saying, look, could retiring in 2000 prove to be the absolute worst time to retire from a safe withdrawal rate perspective? Before then, if we're looking at it on an annual basis, 1966 was the worst year, and that gave us the 4% rule from Bill Bengen, right? So what he was looking at, what Wade Pfau was looking at was, look, we've just come through a bad decade. And remember, stocks were flat over a decade. S&P 500, I'll show you. Let's go back to Portfolio Visualizer. We'll put in, I think SPY goes back that far. Let's just make sure. Yeah. So if we look at SPY, which is an S&P 500, and we put in here 2000 to 2010, lump sum at the beginning of that period, yeah, you'd made $397, right? So the market was flat. In any event, so what Wade Pfau was looking at was, well, boy, could 2000 turn out to be worse for retirees than 1966? And the point that he made in his article, I think it's valid, is that we can get a really good idea of how a retirement scenario will play out. And he was assuming, by the way, a standard 30-year retirement by looking at year 10. Remember, that's the sequence of returns risk. That's the danger zone. Some might put it out even a little further, but that's the sequence of risk danger zone. And what he found was if when you get to year 10, you have less money than you started with, you're in trouble. And if you have more money than you started with, you're not. Well, in 2010, retirees had less money than they started with. In fact, we can go right back here. Let's assume a 60-40. I don't know how far back B&D goes. It probably doesn't go long enough. You know what we'll do? We'll go to, we'll use asset allocation rather than specific funds. So we'll just use U.S. stock market and an intermediate term total U.S. bond fund. There we go. And we'll do 60-40. And we'll go from 2000 to 2010. We'll assume $1 million. We'll take out 40,000 in year one, adjust for inflation, rebalance annually, withdrawal frequency annual, blah, 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 yada, yada, yada. And let's see, we're down to 829. Now his numbers were actually lower than that in his paper. I don't know if maybe he ended it in 2009 or started it in 2001. But we're lower. And that can be a problem. You might think, well, isn't that normal? I mean, we're spending money every year. Of course we're lower. Well, no, not really. We can go over to FI Calc. I have all these up from what I was doing earlier today. This is $1 million, 30-year retirement. This is 60-40 allocation, 40,000 in year one. If you take a year like 1982, here we go. So this is your portfolio balance on an inflation adjusted basis. You started with $1 million. 30 years later, you had 5.2 million, and it just basically went up from day one, right? Anyway, for this poor retiree, when Wade Powell was writing this paper, that I mean, they're not like scraping the bottom of the barrel, but kind of tricky. But we all know the next decade or so kind of worked out for them. So if we go all the way down to the current year, so they were at what, 829. Now this is not inflation adjusted, by the way. They've gone up. They've lived another 12 years, taking money out on an after inflation basis every year, and they're up to 1.1 million. So I guess we don't know what the next 8 years will be, or 9 or 7 years to finish off that 30-year retirement period. But at least so far, they're looking, I think, okay, even in the current year, because this, remember, this 1.1 is up to August, so they've already had the bad year. Of course, we have inflation that's high. We'll see what happens. But anyway, I found that very interesting. So I thought I'd share it with you. Are people still watching? There are a few people. All right, good. John, I have no idea if that was relevant to your question at all. Whew. All right, what do we got? So Cody wants to know, when does paying down a mortgage come into play in retirement planning, particularly how it relates to how much in bonds you'd have? Should it have an impact on your stock bond ratio? Well, I think the first question, I think, is, does it make sense to pay down your mortgage? Let's just start with that. And if you're sitting on, and I know some folks like this, I'm sure many people watching are in this situation. You've got a mortgage that's in the 2s, maybe 3s, and we've seen rates go up. I probably, if I had a 2.5% mortgage right now, I don't have a mortgage, but if I did, I probably wouldn't pay it off right now, because I can go to treasuries short term and get 4%. However, I could very easily imagine a scenario where that will change. I know it seems like with inflation, interest rates going up, are they ever going to go back down? The market actually says they will. Now, maybe not back to where they were, but they could go down to where that 3% mortgage, when you factor in taxes and everything else, may not seem like an incredible deal. Of course, we don't know, but let me show you what I mean. I've shown you this screen before. It's on Fidelity. Here we are. Come on. Is it coming up? Maybe? Yeah, here we go. So let me make it a little actually smaller. There we go. So we'll look at U.S. Treasuries. So this is 3 months, 6, 9, all the way up to 30 years, all the way to the right there. And you notice they start to go up: 342, 378, 413, 424, 438, 444 at year 3. And then what happens? They start to go down, right? That's not a normal yield curve. They should keep going up, right? As the term, the maturity of the bond gets longer and longer, but they don't. They start to go down. And in fact, the 30-year right now, 378, is basically on par roughly with the 6-month. It's like, well, what they call this an inverted yield curve. They often compare the 2s and the 10s. The 2-year 438 and the 10 395. They compare the 2s and the 10s. It's inverted. They often say the inverted yield curve has predicted whatever 15 of the last 8 recessions or whatever. But the idea is inflation is rampant now, so we're demanding higher yields on shorter term bonds. But they're expecting, as the Fed continues to raise rates, here's what the market is saying: the Fed's going to raise rates. It's going to tip us into a recession. It's going to send demand down. People, it's going to send unemployment up. People don't have as much money to spend. The government's got a lot of debt. It's going to be harder for them to keep cutting checks and sending money out for free to people. Although it doesn't seem to have stopped them right now. But at some point, maybe it will. Who knows? Maybe it won't. But in any event, and that's going to eventually cause the Fed to lower rates, once they get inflation under control. And they're going to start lowering rates because we're in a recession. They want to sort of spur activity. And so longer term, we could have lower inflation and lower rates. Now, of course, the market is always wrong. It's self-correcting, right? Every day. So who knows what will actually happen? But that's kind of what the yield curve is telling us the market thinks will happen. So, if I had a 2.5 or 3% mortgage right now, I probably wouldn't pay it off, even in retirement. But that doesn't mean I wouldn't end up paying it off a year or two from now. And we paid ours off, I don't know, 6, 7 years ago, and I have no regrets for doing that. In any event, now that doesn't really answer your question. I personally, here's how I think about it. I generally don't like things outside my portfolio, like you're talking about, affecting my asset allocation. And I'll give you an example. Some will say, calculate the current value of your Social Security or pension, and its current value, and treat it like a bond, and that could be part of your bond allocation. Okay, and that's certainly a valid approach. And you could do perhaps the same thing with a house. If it's paid off, you might say, well, I've got this big equity in the home, and maybe I could tap it, or I could just treat it. It'll go up and down, but I could maybe treat it like a bond. It's fairly safe. I don't personally like that approach, for me anyway. What I like to think about is, what are my expenses? And if that includes a mortgage payment, fine. Okay, that's part of my expenses. And in light of that, what percentage of my portfolio am I going to need to spend in year 1 of retirement? And what's that look like? And if it's 4.5%, that's going to drive one kind of asset allocation. If it's 2%, that's going to be a very different conversation. I mean, at 2%, I can pretty much do whatever I want except set the money on fire. Does that make sense? My asset allocation doesn't matter as much if you're at 2% withdrawal rate. That's why when people say you can live off dividends and interest, yeah, if you have a standard market portfolio that's earning a 2% yield, yeah, the reason you can live off dividends and interest is because you're only taking out 2%. That's really the magic. It's not the dividends or the interest. In any event, I like to look at it that way. So I'll subtract Social Security from what we need from our portfolio. If we had a pension, which we don't, but I would subtract that. I'd add in a mortgage payment if that's what I have. And that's how I would think about the asset allocation. What I would let drive the asset allocation is the percentage of my portfolio that I'm going to need in year 1. Because, and this is what Bill Bengen, and I think just about everyone else that's come after him have concluded, is that if you're going to need something near the high level of what a safe withdrawal rate is, we'll call it between 4 and 5%. You're going to need 50 to 75% in equities, probably 60-40, 70-30. A lot of studies show. There's some that have looked at 80-20. I think Guyton Klinger did, if I remember correctly. But they're all within that range. And so that's what I would be focused on if I'm going to need 4.5% in year one, adjusted for inflation. Now, but the other thing I would do, Cody, I hope this is helpful. I really like a lot of the tools that are available now for planning retirement. New retirement is one of them. On trajectory is another. And I do plan to do more videos on these because you can model them. So what you could do is you come with a base plan that says you're never going to pay off your mortgage. You're just going to, or you're going to pay it off whenever it's due, and whatever 20 years from now you paid it off or whenever. And then you could do what if scenarios. You could do, well, what if I take cash out of an account now and pay it off? How does that affect things? You could model a reverse mortgage, right? If that was something that you were thinking about. You could model, and something my mom did. She moved, right? She downsized. Hey, Mom, hope you're watching. Love you if you are. I love you even if you're not watching. Anyway, so she was able to go from a mortgage to no mortgage and living in the same area where she lives, but she downsized. So you could model all of these things and then run Monte Carlo simulations on all of this. And that's probably what I would do, rather than trying to make the decision off of just some heuristic, which is a fancy way of saying a rule of thumb. I think that's my answer. I'm sure if I played that back, I probably wouldn't like some of the things I said, and I would think, nah, that's wrong, Rob. What were you thinking? But I can't play it back, at least not right now. So there you go. I'm in one of those moods today. I lost 2 chess games in advance of this show, both of which I was crushing my opponent. I hate when that happens. Do I think it's reasonable to keep an emergency fund in 4-week treasury bills? Sure. There's almost zero, virtually no interest rate risk. The question would be yield. So right now, I don't know what the 4-week is. It's not here. Actually, I don't know that I do think that's reasonable. Hang on. 4-week treasury bill rate. What's the yield right now? Well, if this is correct, it's 2.65. Is that right? Yeah, I probably wouldn't keep it in a 4-week treasury bill at that rate, because you could do better with a no penalty CD. I think the top one from Save Better, which I've talked about in the past, is 305. But even if you didn't want Save Better, like if you just wanted a standard money market account, not a money market fund, they're different, right? A money market account or a savings account. Let's see what I'm showing on my site as the best. So we'll go to savings accounts first. So there's that 305 on a no penalty CD. But we've got Basque Bank at 275, Axiom Bank at 275, Ivy at 270. So, it's compared to at least the yields I was seeing, if I'm correct about that, you could do better. And you could go with the 6-month, but there's going to be times when they're not as good. So you could think about that. But certainly from a safety and security, obviously treasury bills are as secure as you get. I don't personally value FDIC insurance above the safety and soundness of the U.S. government, since they're both coming from the same place anyway. Money market accounts, I think the numbers are about the same. Oh, look at this. Merchants Bank of Indiana, 305. I don't know if that's available to everyone or not. Normally on this site, so I have a team of great people that help me keep all this. So they know the rates even better than I do. We normally only focus on accounts available nationwide. So you might find something better in your local area. But there you can see some rates. This is a Save Better account. This is not. Sky One Federal is a Save Better account. This is not. Anyway, so, I would look at yields that would be relevant. So I think at least given those yields, I'd probably prefer an FDIC insured account over like a 2.5% treasury, I think. David. But again, you might go further out on the yield curve and do a little better. Part of my thinking on emergency funds too is like, there's two kinds of emergencies: income and expense. So an income emergency is when you lose your job, right? Or maybe you don't lose it, but you were getting a lot of overtime and now you're not, or you're expecting a bonus and you just learned you're not going to get it. But losing your job is sort of the ultimate income emergency. An expense emergency, the car breaks down, water heater goes out, whatnot. And at least on the emergency kind, or the expense kind of an emergency, even though we've always had an emergency fund, or most of the time we have, for that kind of emergency, I'm likely to put it on a credit card first, and then have 30 days to pay it off in full. Well, I'd put it on a credit card anyway, just from the cashback rewards perspective, assuming that I could. Say it's a car repair, or a new furnace, whatever. But you might have time to get access to your money. So I kind of factor all those things in and thinking about where I'm going to keep the emergency fund. All right. So B Diggity 1 says, I have a pretty decent amount of money currently sitting uninvested in a Roth IRA. What would you do with it at this point in time? Well, I don't know a thing about you, but I'm going to assume someone is working decades to go for retirement. They've got a Roth IRA. If that's the only account you have to invest in, you have nothing else, what I would do, I can't tell you this would be what you should do, but I can tell you what I would do. I would put it in basically probably a 3-fund portfolio. I'd probably put 60% in a total US market fund, maybe 70. Yeah, maybe 70%, 20% in an international fund, and I'd still probably keep 10% in bonds. If I were 20, maybe I'd put it all in stocks, or 30 maybe, but I kind of like a little bit of bonds, as I've said before. There are plenty of other reasonable approaches. You might say, well, I'm not going to put 70% in a total market. I'll put 60%, and I'll put 10% in small cap value. That makes a lot of sense to me. Based on history, don't know if it'll repeat itself, but historically, small cap value has done well. It's interesting. I've been doing a lot of reading about a modern portfolio theory, the efficient frontier. I don't know if these terms mean anything to anybody. The CAPM, capital asset pricing model, FAMA in French, 3-factor. They did a 3-factor where they said it's not just risk, but it's also the size of the company and value versus growth, which really was what DFA kind of grew out of, was that research. Now they've gone to a 5-factor model, which is interesting. But I've sort of been digging into that research, which is a lot of math. And so I'm slow going through these ginormous formulas. But the thing I'm trying to figure out is, I know, as we all probably do, if you've watched the show, small cap value has done very well over the last, 50 years. Not necessarily the last 10 or so, or 20, but certainly long-term it's done extremely well. But how confident can we be that over the next 30 years it will do extremely well? And is it reasonable to at least think that it will enough to put 5, 10, 15, 20%, whatever, in small cap value? That's what I'm trying to wrestle with. I don't have an answer to that yet. So here's an interesting question that people have been asking me more and more. So I need to come up with an intelligent answer on this question. I'm not sure I'll be able to tonight. But the question is, how do I know when to sell my IBonds? When high yield savings account provides higher yield, keep forever, as I guess a bond portion of a portfolio. I'm a long-term index fund Boglehead in the accumulation stage. It's an interesting question. I mean, we certainly don't have to deal with it now, right? There's no reason in my mind to sell an iBond right now, and there probably won't be for a little while. And it gets back to whether you should really sell it all. I'm inclined not to sell. They are inflation adjusted, and I like that, right? I have plenty of nominal bonds, regular treasuries and corporate bonds through through funds that I own. Could there come a time for a period where the interest rate is lower, the yield is lower than you can get, as you said, on a high yield savings account? Well, yeah, I'm sure that's possible and probably will happen at some point. But as we know, once you sell, you're back to buying 10,000 a year at a time, more or less. Couples can do more. You can gift them. You can do the 5,000 through tax refund, but and they are inflation protected. Of course, you can always go with tips to begin with, I suppose. And there's a good case for doing that just from an ease of management perspective. But I know people that have $250,000 in IBonds making almost 10% right now. To have that, they had to have IBonds when they weren't as attractive. And it kind of gets back to that asset map we were looking at, asset class map, where the point of diversification, among other things, is to not put all your eggs in one basket, but it's even more than that. You can actually add a risky asset to a portfolio that brings the risk of the portfolio as a whole down, right? I mean, that was really modern portfolio theory, right? Harry Markowitz, in his 1952 paper, I think it was. And so IBonds right now are good, and some periods of time they won't be as attractive. But I'm more inclined to just keep them and recognize that on any given year, some of the asset class exposures that we have will do really well. Some will do average, some will do very poor, and just leave it alone, because that's going to shift around all the time. Like we see this, right? It's going to look like this. It's constantly changing. Where's it going to stop? I don't know. It changes every year. So I like to be the lighthouse. Let everything around me move, and I'll just sit still. Sometimes close my eyes if I have to. I'm the lighthouse. At least I try to be. Sometimes I tilt a little bit, but usually not. I don't break, at least not yet. Okay, I don't know. Was that an answer to when to sell the IBonds? I think you guys just ask me questions. They're good ones. And then I just say whatever I want, whether they relate to the question or not. TC wants to know, is there any realistic chance we end up like Japan in the 90s? Well, I think personally, I don't think so. I think we have a far more diversified economy, a more diversified culture, which affects things like, I don't know Japan, I've never been to Japan, but from like an immigration perspective, and I know that's a big issue in our country right now. That's always been an issue, I guess, in some ways. But I mean, it's crazy what goes on. I won't even get into the politics. That'll be bad. But I just don't see us. We're certainly aging, no question about that. And as we age, healthcare expenses go up. As a country, right? Our retirement, Social Security, state pensions, more and more stress, which is one of the reasons that immigration is probably so important. I don't know what that looks like in Japan, but I suspect it looks very different than it does here. So I don't really see us. That's not to say we're not going to have our own issues for sure, but I don't really see us becoming the Japan of the 1990s. But I'm no expert on Japan, so there you go. Would love to visit. Okay. MJ says, Rob, the year isn't over. We have no idea where it will end. Can't compare to prior years until 12/31. Well, that's certainly true. Yeah, I'm comparing like where we are now. But yeah, who knows? Who knows? Could get better, could get worse. That's what makes all this so much fun. All right. Josh wants to know if I can share the link to the asset quilt. Oh, I like that. It does look like a quilt, doesn't it? So if you just Google asset class return maps, right? And I was on this novelinvestor.com website, but you'll see all kinds of, a lot of these sites have different ways of looking at it. That's actually a correlation map. Says it right here. But that's where you'll find it. All right. Patrick asks, do you still have your Apple position? When would you consider unwinding a large single stock position and moving to VTI or VU? So the answer is yes. I'd sold some of it last year just to decrease my exposure because the gains and whatnot. I mean, I've owned chunks of it. Well, I've bought it in like 3 different chunks, but the oldest is from 2013. So I would say roughly for every, and this is for all the chunks I've purchased. Chunks. I'm not sure why I'm calling them chunks. I think for every $3 I invested, I've earned 10, not including dividends. And so I did sell some. And it's also what we give to charity. So when we're going to give to the donor advised fund, we give Apple stock because it's our biggest gain. Beyond that, I don't have any plans to sell. I do think we'll continue to reduce at least the number of shares based on charitable giving each year or every other year. But at least right now, I don't see any reason to sell. I think it's still a good investment. It is a not insignificant part of our portfolio. But again, that will come down, as we give more away. That's my current plan. In terms of when to know, I mean, we would take a huge tax hit if we sold. Now that's not a reason not to sell. Well, it's a factor to consider. I mean, but if I thought there was reason to sell, then I would take the tax hit. But if you're nervous because you've got a large single stock exposure, then within some reasonableness in terms of the taxes you're going to incur, maybe you have some tax losses you can offset one year, you can begin to whittle away that exposure. Yeah, but for me, I still think it's a good investment. It'll be interesting because I think they're just a cash cow at the moment. Even, people talk about how their iPhones, it's what? Evolutionary, not revolutionary. That's what they call each upgrade, but they're still making money hand over fist. And I don't see that changing. I mean, obviously they'll have ups and downs. What will be interesting is what they do with cars, number one, if they get into them and how they get into them. That kind of actually scares me more than excites me. Because that's a whole different thing. And then they talk about glasses, some sort of, virtual reality kind of thing. That could be big, maybe. We'll see. But it still makes me a little nervous. Anyway. All right. Rob, can you explain how T-bills pay out? So if you buy a T-bill, say you buy $1,000 T-bill, you're going to pay less than $1,000, assuming the yield's not negative. So this is make up a number. Let's say you pay $990. The amount you pay is based on an auction, right? There's an auction, and that's what sets the yield. So the interest you're going to earn is the difference between what you pay and what you get when the bond matures, and it's a T-bill, so it'd be on a year or less. So you'll get the par value at maturity, that $1,000, and the difference between that and what you paid is your interest. So they're what are called zero coupon bonds. They don't pay interest along the way, which means, among other things, that their maturity and their duration are the same. I don't know, for what that's worth. Okay. Well, Coculti, I guess, I don't know. If you live off dividends, then prices don't matter. Well, in one way, that's true. Assume the risk of living off dividends is that it depends on what we're talking about. If you've got a 3-fund portfolio, by that, what I really mean is just a market portfolio. You're basically just following the market in index funds, and you can live off the dividend. and you're comfortable, that's a pretty safe thing, because you're living off of what we saw in the yield for the S&P 500, 1.5%. You've got some interest on some bonds. I don't know, let's call it 2% total. And you've got a very down the middle sort of market portfolio. The issue comes in when people say, well, you know what I'm going to do? I'm going to buy some REIT that pays 5%, or some covered call ETF, it pays 9%. The problem with that is the values of the underlying funds can go down. When you're getting into those higher yields, total return can take a hit. And you might say, well, but it doesn't matter, I'm still getting 9%. Yes, but 9% of what? You're 9% of a smaller and smaller and smaller number. It can be a real problem. But yeah, if you're living off dividends and you've got your basic market portfolio, I mean, the thing that makes that so good, though, is not that you're living off your dividends. I know that makes it feel safe because you're not selling shares. But when the dividend gets paid out, the value of your stock or the fund is going down dollar for dollar. That's how it works, right? I mean, and that makes sense. If a company is worth $10 million and they take $1 million in cash and pay it out to their investors, what are they worth now? Not 10 million. They just gave $1 million away for nothing. They didn't get $1 million in equipment or inventory. They got a thank you from their investors. So they're now worth 9 million. Yeah, what makes it such a reasonable approach is that you've got a market portfolio and you're just living off of 2%. You can imagine Berkshire, which doesn't pay a dividend. Let's just assume, for the sake of argument, that represented a market portfolio. It's going to go up along with the 60-40 portfolio, but you get no dividends. But you're only going to sell 2%, enough to generate 2% of the value. It would be great. It would be the same thing. It's not the dividend part of it that really matters. Hope that makes sense. I don't know. All right. Mad Max. Question on buying long-term treasuries. If I don't plan to hold to maturity, is it unadvisable to buy a heavily discounted note to get yield versus one with a higher coupon rate? How are you buying a heavily discounted long-term treasury? I guess that's my first question. I guess if rates have gone up, so you're buying on the secondary market, rates have gone up. In any event, I don't know. I'd have to look at the specifics. I guess part of it depends on how long you plan to hold it, right? The thing you have to remember is this with long-term treasuries is that they have greater interest rate risk, right? And one way to think about it is imagine that the current rate on a bond, doesn't matter what it is for the moment, is 3%. And someone comes to you and says, well, I've got a bond that's only paying 1%. Would you buy it? I'll give you a discount of something, but would you buy it from me? And, sure, if we can agree on the right discount. And they say, okay, well, it's paying 1%, but it matures tomorrow. So you're only stuck with this 1% for a day. All right, well, we just discounted a few pennies or whatever. Good. On the other hand, if they said, yeah, you're kind of stuck with this for 30 years. Hello. Okay. Well, you're going to need a bigger and bigger discount, right? So, so buying long-term treasuries just in general presents more interest rate risk. Now that means it also presents potentially more potential. And if you look at long-term treasuries, some years have been incredible. Let's look up Vanguard. Hang on, let me show you this. Here we go. This is Vanguard, just a Vanguard long-term treasury fund. We go to performance. So this year, right, not so good. It's lost 26.5%. But look at some of these years. 2020 was up 18%, 14% in 2019, 25% in 2014. These can have wild swings. What's the standard deviation? Look at that, 12, almost 13%. That's pretty significant. It's not S&P 500, but boy, that's a pretty significant volatility. So, but back to this question in terms of heavily discounted note to get yield versus one with a higher coupon rate. I guess I'd have to look at specifics. I mean, if you're talking about two treasuries with the same duration, same maturity, I don't know how one would be different than the other. I don't think I've been very helpful on that question. By the way, if you want me to address a topic, put @RobBurger in your question. It helps me just get through all of the stuff. Helps me ignore all of your back and forth between one another, which is perfectly fine. But it helps me just skip over it. Mike, I couldn't agree more. He says, as Jack Bogle said, buy right, hold tight, and don't peek. I haven't heard that one. If we have a good plan, we will be fine. We need to stop listening to the talking heads and stay the course. So true. Oh, we have someone from Brazil. Welcome. Gustavo. How are things in Brazil? What's the inflation rate in Brazil? %8.73%. Pretty much what it is here. That's an interesting dynamic. We talked about emerging markets. As the dollar goes up, a lot of these emerging markets have borrowed in U.S. dollars. They transact in dollars, or in some way, are buying goods from outside their country, and so we can effectively export pretty significant inflation. And if it gets bad enough, we could have some issues, pretty significant issues in emerging markets. I'm not predicting that. I'm just saying that's not out of the question at all. All right. I'm not sure I follow this question, but it looks interesting from Mr. Walk. By the way, anyone see, well, hang on, I'll come back to that. Let's first deal with this question. 70-30 stock portfolio, 70-30 stock bond portfolio, or 3-part US ex-US bond portfolio for average Joe, or straight up VT. Well, I don't understand. So the 70-30 stock bond portfolio or 3-part US ex-US bond, I'm not sure what the difference would be. I mean, you could make the 3-part US ex-US bond portfolio a 70-30 portfolio. I guess you'd have to just figure out of the 70%, how much goes in US and how much goes in international. I think a VT approach is perfectly fine. For me, it's got a little more international exposure than I'm personally comfortable with. I think it's around 65 US, but I could be wrong. I'm looking it up now. 60 US, 40 international. That's a little rich for me. I'd prefer to keep international around 20%. That's my own personal preference, for what that's worth. I have to say, JD, no one, I don't think, has ever compared me to Larry King. I get an Anderson Cooper comment every now and again. As a kid, I got Huey Lewis. I don't know. But Larry King, even with a microphone, I got to tell you, I'm not seeing it. Not seeing it. All right. A lot of conversation about crowded highways. Interesting. So this is a question that, Joe, maybe you emailed me. I got this question the other day, today. Pension, should you take a pension as a lump sum or as an annuity? Using the annuity calcs for joint life, if I take my lump sum and use to buy an annuity on the open market, I do better by 14% per month. Any drawbacks? Hang on, let me read that again. If I take my lump sum and use it to buy an annuity on the open market, I do better. Got it. So let me repeat this back as I understand it. You have a pension. You can take it as a lump sum, or you could take it just as effectively an annuity. You pay out each month. What you're saying is, if you take it as a lump sum and then take that money and buy an annuity, you'll do better by 14% per month than if you just stick with the pension and have them pay you out monthly. Any drawbacks? Well, a couple of thoughts. First of all, I'm assuming the pension is not in any way adjusted for inflation or has increases, because annuities, there really are no inflation indexed annuities anymore, at least that I'm aware of. There are some that might have some minor increase, but you want to look at that. The other thing to think about is you might have more options with a pension, maybe, in terms of if you have a spouse, what they get if you die first, or any sort of guarantees if you die in the next few years, let's say. Now, annuities have some of these features too. You've got to pay for them. But you want to think about the payout options in the pension, what they offer, and compare that to annuities. And then let me pull up an article. If I can find it real quick. Yeah, here it is. So I think I linked to this in my newsletter that goes out every Sunday. If you haven't subscribed, the link, I believe, is below the video. Yeah. So this is an article that from the Oblivious Investor, Mike Piper. I know Mike. I haven't talked to Mike in ages. He's going to be at the Boglehead conference, which I will be at. Let me remove the comment. So Mike will be at the Boglehead conference. I'm looking forward to catching up with him. He's written some great books, but he did this article recently, lump sum versus monthly payment. And I think this is an article worth reading. In any event, there it is. So if you just Google pension choices, lump sum or monthly payment, if need be, you can throw in the Oblivious Investor name and you'll get this article. I think it's worth reading. All right. Ron wants to know, hold or sell VTSAX? Well, why would you sell? I mean, I don't know. Do you need the money? It's the total stock market index, Admiral shares. I mean, if it's part of a diversified portfolio, you got a plan. I personally haven't sold anything. Mike, I'm glad you could catch the live stream as well. So Dave wants to know my thoughts on how Fed Chair Powell is performing. I'm probably in the minority. I think he's doing a pretty good job. I get that many criticize him for starting too late, and I get it. It's real easy, sitting here to criticize him for that, and I get it. Maybe in some postmortem, we'll figure out maybe we should have started raising rates earlier. But I think he's more or less doing what he needs to do. It's tough. We've got fiscal policy that's not helping him. It's just not. I was watching I think it was Squawk Box. Is a CNBC. Was it Squawk? I don't remember. But they were interviewing one of the economists that works at the White House about the inflationary effects of the whole paying off student loans. And the point that they made, and I forget the name of the gentleman, but he said, well, we're gonna start requiring borrowers to start paying back their student loans because they've been deferred now since COVID in January. And that's going to offset the inflationary pressures that paying off some portion of student loans, what is it, 10,000, I think, will create. And so it's sort of a wash. So we're good. And I thought, well, that's not really great analysis, because what that tells me is if you didn't pay off the student loans, then when the payments kicked in January, it would actually help us push down inflation. So what you've said is because we're paying off all these student loans, it won't help us at all. Now, you're saying it won't hurt us. Great, I guess. Now, Now, by the way, that's got nothing to do with whether paying off student loans is a good or bad policy. I don't really want to get into that. I'm not a fan of it at all, but so what? Um, so that's just one example. The whole Inflation Reduction Act, I think, is problematic when it comes to inflation because it does a lot of things to encourage people to spend money, maybe for good reasons, but from a let's fight inflation, I don't know. I think the Fed is trying to fight a number of things, including fiscal policy. So I think he's done a pretty good job so far. I like the message he's communicating. And I think I'm in the minority on that. All right. Greg wants to know, what financial products, services, or news sources do you find worth paying for? Not MS Premium, but Bloomberg Financial Planner. Well, it's a good question. I do actually pay for a Bloomberg subscription, not the terminal, just the news. I like their news. I don't actually subscribe to the Wall Street Journal. I wonder if can you subscribe through the Apple app or through the App Store? The reason I don't subscribe to the Wall Street Journal is because in order to cancel, you have to call them, and that drives me nuts. Anyway, that really wasn't your question. I like New Retirement. I pay for that. We've looked at it before. I did a whole live session on New Retirement, but here it is. This is what it looks like. But this is what models, retirements. I pay for a lot of different ones, mainly because I'm testing them. Let me pull that off. But I like New Retirement a lot. I like On Trajectory, but it's very different. And I'm still testing it, but it's here. But New Retirement's the one I've used the most right now. What else do I pay for? I do pay for Morningstar, but I wouldn't recommend it. And I probably won't renew it again. I don't like the direction they're going with their portfolio tracker. I just use Personal Capital for that, and that's good. And that's free. I've been experimenting with a lot of budgeting apps. Currently, I'm using Quicken, Personal Capital, Truebill, Simplify, Monarch Money. I'll let you know which one I end up with. But that's mainly because of, the YouTube channel and, obviously you just want one and you pick it and it works for you and that's good. But beyond that, I don't really use a lot beyond that. Here's one that I was going to do a review, mention. This is actually an advertiser, but I've literally never mentioned it to you. I know the founder. I met him at a conference. Here it is. It's called Fortunately. And it's a 30-day free trial, and then it's like $5 a month. But this is a very interesting tool, which is why I agreed to work with them. That is designed to help you juggle multiple financial goals at one time. Like you want to save for child's education, you want to save for retirement, you want to pay down debt. You could put all of those things in this tool. You can connect your account if you want, or you can just manually enter them if you prefer. And it's got a lot of, I think, promise. It's still very much in the early stages of development, but it's already got a lot of functionality. So I think that's worth checking out. I don't know that this is ideal yet if you're in the decumulation phase. You're already retired and you need to figure out Medicare and Social Security, and should you buy an annuity? Should you do a reverse mortgage on your home? That to me is more New Retirement at this point. But yeah, that's a pretty interesting tool. I'll probably talk more about it when I've used it, but I want to dive into the details more before I really talk about it more in depth. Who knows when that's going to happen? Is it 8:30? Holy cow! Well, I feel like I haven't even scratched the surface of these questions. Well, this is an interesting question, Nicholas. For expats who can only contribute to taxable accounts, how would saving for retirement be different? Can you talk about tax cost ratio? How tax cost ratios? I'm not sure what you mean by tax cost ratios. Should I know what that means? This is like a Morningstar thing that gives you an idea of the impact taxes have on a fund's returns, right? I think that's what you're referencing. Yes. So this I am familiar with. This is, by the way, this ugly website is an old version of Morningstar. The problem with the tax cost ratio is it has to make assumption. I don't know how they do it. And I'm sure they disclose it somewhere. I could look. I don't know. Your tax situation, right? And one's tax situation is different. And so the impact investments are going to have, the taxes are going to have on your investments is going to depend on, what your taxes look like, and what, at least in the US, your tax bracket and what state you live in. And so, this might give you some rough idea maybe to compare different funds. But one of the reasons I've not spent a lot of time focusing on that is because if you're investing in index funds, they're about as tax efficient as you can get. There are some tax managed funds that maybe you could consider. But I would probably at least spend some time talking to someone who's dealt with these issues a lot to see what your options are. I had Mark Zorel on the show. You can look up his video. He's with Plan Vision, and I'll show you. It's planvisionmn.com. He's very inexpensive. Here's the website. He works with a lot of expats. It's probably worth having a call with him. There's a process you have to go through, but it's very inexpensive. What's he charging now? It's like, I don't know what the cost is. It was $96 a year. Let's see. I don't want to get into all that. It's cheap, but you can look at his website and figure it out. It's probably what I would do just to make sure you don't have options that maybe you're not aware of that I certainly wouldn't know about. But beyond that, I mean, if you have index funds, it's pretty tax efficient. Yeah. Okay. Well, I'm going to have to call it a night. For starters, it is Monday Night Football. Don't we have the Manning cast tonight? I'm looking at, there's like 550 people watching this right now. I mean, you must have football on at the same time. It's like a dual screen situation. You've no doubt muted me. I'm just why you listen to football. I get it. That's what I would be doing. I think it's Manning cast tonight, right? Do you guys like that as much as I do? By the way, have you noticed I've started doing some YouTube shorts? I mentioned that earlier, 60-second videos. They're kind of fun. So here's the deal. What I should do is go back. Maybe here's what I'll do. I'm going to go back through this chat after this is over, because obviously I'm not going to. I'm at comments that were made at 7:25. That's where I am in the chat, and it's now 8:32. That's how far behind I am. Now, a lot of this is banter amongst yourselves. Good. But I will go through this. Norse mythology. Did you just write Magnus Carlsen ? Really? You must be joking. Particularly Norse mythology. Anyway, I'll go back through your comments and your questions, and if there are any that I think I can answer in 60 seconds or less, which is how long a YouTube short can last, can't go longer than that. TikTok gives you 3 minutes, but I'm not really on TikTok. I say not really. I think I did 2 videos, but I don't know. I'm just going to stick with YouTube for now. I will go through this and try to answer some over the next few days, because I always feel bad I don't get to them all. But I literally think I could keep doing this until like midnight, and I wouldn't get through them all. So I think that's what I'll try to do. I'm thrilled that you guys hung out with me for, I guess, an hour and a half. I will have more videos this week. Planning to be here next Monday, Lord willing, and the creek don't rise. And now I think I'm going to go watch some football. You guys have a great week. And until next time, remember, the best thing money can buy is financial freedom.